Welcome everybody to TrustEd University, hosted by ITM and LitGo. And today's discussion is about the strategic uses of private placement life insurance. And if you haven't ever seen this topic or been around the people that present this topic, you're in for a very good treat today. Let's go to the next slide. Just a quick announcements and reminders, a little housekeeping here. Please complete our short post-event survey. You'll receive a link to the presentation and also a link to request your continuing education credits. And if there's any questions, please feel free to put them into the questions box and we'll answer them either during the presentation or we'll save some time at the end to have any questions and answers as well. I'd like to introduce myself very quickly. My name is Michael Moore. I'm president and owner of CDP Insurance Services. We're a third-party administrator firm that specializes in life insurance premium financing. But that's not important. What's important is the gentleman that's joining me today, Mr. Frank Seneco, a nationally recognized speaker, author, and expert on private placement life insurance. Frank is president and owner of Seneco Global Advisors, works with very high net worth families, international tax firms, and some of the top accounting firms in the nation. Frank, I'm going to let you take it away, my friend.
Thank you, Mike. It's very nice to be here, and thank you to LitGo for having me. To everyone that's attending, good morning and good afternoon. I know we have people in different time zones. Again, my name is Frank Seneco, and it's a pleasure to be here. As Mike mentioned, I am the founder and president of Seneco Global Advisors and our related companies. We are based here in New Haven, Connecticut. We are a completely independent advanced planning firm. Our focus is on structuring sophisticated life insurance plans for high net worth and ultra high net worth families here in the United States and internationally. The main focus of this work is implementing these insurance structures within existing trusts or entities or new trusts or entities that a client's advisors would put in place as part of their multi-generational estate plan for income, gift, and estate tax minimization. So the insurance plans that we put in place, and as we're going to cover today, private placement is a piece that fits into a larger plan. I have been in the insurance and financial services industry for 35 years. I've been doing this my entire adult life, and I've been working in the private placement space for 25 years, and that's both on the U.S. and international side. So what we're going to cover today is just private placement life insurance. This is something that's been around in the U.S. for decades. I mean, since the mid to late 80s, U.S. individuals and families have been using this. Globally, families have been using this even longer. It's gotten a lot of attention in the last, I'm going to say, 5 to 7 years. Some of that good, some of that bad. But this is a proven planning strategy that has been being used by business owners and high net worth individuals for a long time. So that's what we're going to cover today. So what we want to go over, the discussion points, is just what is private placement life insurance. It's also known as PPLI, and I'm going to refer to it and throughout our presentation as PPLI. How does PPLI work? The types of policy designs and structures that clients can enter into, and the use of those designs in various planning. And Mike, I know as we were talking prior to going into the presentation, I think there'll be some questions. If questions wind up coming up, please let's go through those, as they come up on your screen. But what we like to start with is the financial challenges facing the high net worth clients today. And this has been something it's pretty constant over the years. It's the same things that we see. But what these high net worth clients and families are challenged with is how to effectively transfer wealth to future generations, not just from a tax perspective. How do they effectively minimize income taxation on the growth of investments? How to minimize transfer taxation on an overall estate, and that's going to be a big focus of what we're looking at today. how to protect an estate from predators and creditors, and how to maximize the return on tax inefficient assets or investments.
Frank, I know you're going to get to this, but what is a high net worth client?
Well, I mean, we deal with a lot of different practitioners, being a practitioner myself on the insurance side, but if you're talking from an insurance provider, an investment individual, an attorney or a CPA, I guess some of it goes back to what they view the market that they're working in. From my standpoint, I would take a high net worth person, probably 30 billion and above of assets. But I, talk to other individuals and they'll use a lower number. So, for our practice in planning, it would be 30 million or above for high net worth. Ultra high net worth is going to be 50 plus, well over.
Excellent.
So, I mean, getting back to, as I was mentioning, and thank you for that, Mike, the challenges facing the high net worth client, everything that I mentioned, we're going to really summarize these up as wealth transfer and legacy creation, asset protection, and tax efficient investing. And that's really what we're going to focus on here today, is the tax efficient investing part of this. Thank you. So, what we're talking about for PPLI and just in planning, everybody's always talking about taxes. I mean, we've had the recent passage of the big beautiful bill, which that's going to have an effect for all clients. But with current tax rates, I mean, high net worth investors, families, family offices, they're all still subject to high federal and state tax burdens. I mean, just for 2025, the effective tax rate on a high net worth individual could exceed 50%. And that really depends on the state of residency. So that's not for everyone, but just depending upon these high tax states, if hypothetically, somebody's in California or New York, or just to name a few, you could be exceeding 50% tax rate. The ordinary federal rate right now is 37% is the highest rate. We could be seeing increases in state income tax depending upon state of residency. Just Mike, a state where you are, we've talked about this. I mean, California is 13.3 at the highest rate. Could those go up at some point? I mean, it will all yet to be seen. We've got 20% federal rate on capital gains and qualified dividends. And then we have the 3.8% Obamacare net investment income tax, or the NIT is what we also call it. So these are the type of things that just high income earners, high net worth families are dealing with, and they're all looking to always plan around this.
Frank, one of the other things that we don't talk about enough, I believe, is those states that don't necessarily have a high income tax, but that do have an estate or inheritance tax. And I believe there's 17 states and Washington, D.C. that have a pretty significant state inheritance or death tax. And so if you're in one of those 17 states, you really should make sure that you know the rules there and the laws. And trusts become a big part of the planning, along with the insurance that Frank and I are both a big proponent of.
Yeah, thank you, Mike. I mean, and I didn't look up the recent number of states, but I mean, yes, that's a very important thing to point. Look, we've got federal estate taxes after a certain level. You've got state estate or inheritance taxes, as you've mentioned. Clients are dealing with gift tax, can be mostly at the federal level in some state situations. And you've got the income tax. We've got various taxes that clients are looking to plan around that we all have to take into account. Next slide, please. So, we're talking about private placement life insurance, and we refer to this as an efficient solution. I mean, private placement life insurance, PPLI, this is an internationally recognized tax efficient solution. And what it does, it allows customized investment portfolios that are run on a discretionary basis, and that's very important, to grow in a completely tax-free environment. So let's stop. Just think about that for a moment. I mean, this policy, this structure, this product can allow assets to grow in a completely tax-free environment. There's not a lot of vehicles out there that we can do that with. So when we structure it properly, I mean, PPLI allows for the growth of the investment earnings on it's really the tax-deferred basis. We can access it tax-free if it's structured properly. And an additional benefit, it can be protected from creditors depending upon the state that the policy is issued in, or the structure that it's issued within, such as certain trust structures. And a big thing is it's widely used as a tax blocker in multi-generational wealth planning, and that's what we're going to get into here. So, PPLI, what is everybody, it's just so funny. I've been in this business for so long, and, we always hear people talking about PPLI, and when you really boil it down, I mean, it's a variable life insurance policy. This is a variable universal life contract, and for all intents and purposes, everything we're going through here today is U.S. domestic planning. So it's a variable life insurance contract. You have the opportunity to choose between a wide variety of investment options, which can include hedge funds, alternative investments, things such as private equity, private credit, just to name a few. What it does is it allows tax inefficient investments can be made tax efficient if they're held within a policy. And we're going to drill down on a lot of this further. But overall, I mean, it's a low-cost structure with institutional pricing. I like to talk to clients about this, that it's more of a wholesale-based structure. It doesn't have all of the high loads and fees of a retail insurance policy. It doesn't have the back-end surrender charges. And I like to equate this over to when you're looking at what some corporations use in COLI, corporate-owned life insurance structures. This is just something that high net worth families have been using. So it's a low-cost structure, institutional pricing. One of the most important things here is because it's a variable universal life insurance contract, it's part of the insurance company's separate account. And that would be the same as for a retail variable policy as well. Let me step back for a moment. Insurance companies have a general account, they have a separate account. General account product is going to be a whole life, an index policy, a traditional universal life contract. Those are part of the insurance company general account. They're subject to the claims and creditors of the insurance company if anything were to ever happen with that insurance company. A separate account product is a variable product, a retail variable policy, a private placement contract. What that means is the cash values that accrue inside of a variable contract are walled off as part of the insurance company's separate account, and they are not subject to the creditors of the insurance company if anything were to happen with that insurance company. That's very important when clients are looking to deposit good-sized sums into these type of contracts. They want to know that if anything happens with the insurance company, their cash is walled off. So we'll touch on that a little bit further. The thing is with the product is it's only available, you have to be an accredited investor and a qualified purchaser to enter into a private placement life insurance or a private placement variable annuity. That's an SEC rule. It's not an insurance industry rule. That's something the SEC came out with. So we have to abide by that. And a big thing with these type of policies is typically require a minimum of $5 million of contribution. Even $5 million, I would say, is on the lower end of the type of deposits we've seen going into these policies. But typically we look to client committing to $5 million of deposits for this type of policy. So let's just go through the differences of, I mentioned retail, I'm going to talk about a variable policy. What's the difference of a private placement life insurance versus a retail variable universal life contract? They're both variable universal life policies. On the left, what we have is the retail VUL, and I'm going to include the variable annuity, the VA here. This is offered to anyone that would regularly qualify for insurance. So you're going to have, this is going to be offered by many of the big name insurance companies. You're going to have a set investment list that you can choose from. And I'm not going to go into any names, but it's typically the different mutual fund-like options that are available on an insurance company platform. So the insurance company chooses those. It has street pricing. I mean, the policies are filed. They have their loads and fees all built in, commissions as well. They'll have surrender charges built into them typically. So that's what I mean by saying street pricing. Preset custodian. The insurance company will set which custodian is going to hold those variable assets. It's more of a fixed structure. So great. I mean, the concept of variable universal life, it's a great concept. It's just more mainstream is how I would say. There's not a lot of flexibility there. The difference to the other side is when we go over to a private placement variable universal life, or even with the annuity, And again, a client has to be a qualified purchaser and an accredited investor to get into this. But we have more customizable investments. And when I say that, we're going to drill down into this further. This is not where the client just picks, XYZ investment to go into a policy. It's where you can have the investment manager can have more say in the different avenues that they want to go down for investments. So it's more customizable. It has institutional pricing, as I had mentioned. I mean, previously, it's more of a low-cost structure. We can actually reduce the state premium taxes that go into a policy like this, such as if you're dealing with ILITs in South Dakota. South Dakota has a very low state premium tax. Flexibility on the custodian that's going to hold the assets. With the specialty carriers that are in this space, a client may say, I want to work with XYZ custodian to have my policy assets there, compared to just the insurance company telling them where they have to put it. So it's a more customizable structure. And overall, what we describe to clients is PPLI, it's a more efficient structure for tax planning and wealth accumulation than in a traditional variable policy. Thank you. So as I mentioned, an efficient tax accumulation vehicle. And I want to stress that this is a life insurance policy. It's a variable universal life insurance contract with alternative investment options. So you're really getting the benefits afforded to life insurance, whether a client was utilizing a whole life, a universal life, a street variable policy, or even a private placement. You're getting the tax benefits afforded to insurance, which is very powerful. So we get tax-deferred accumulation of the cash values that accrue inside of a policy. We can have tax-free access to those cash values during lifetime via policy withdrawals and loans. It depends on how the policy is structured. We'll get into that a little further. It has a tax-free death benefit. Under 101 of the code, you're going to have an income tax-free death benefit on the policy. If it's held in the correct estate-exempt structure, such as an irrevocable trust, policy will also be free of estate taxes as well. You can have your choice of investment manager. This depends on the insurance company that you're working with, but the specialty carriers are more open to working with. We have clients that come along all the time that, I'm working with a very large RIA. I'd like them to potentially be the money manager. They have to go through a due diligence process, but clients can look to have an investment manager added as the manager of the underlying policy assets. Again, you can have customized investment options. Those managers can come up with various portfolios that like to run inside the policy. So it's more of an open architecture on the policy design and investments with this type of a policy.
Frank, I've heard of people putting their businesses into a PPLI policy. Is that kind of fall under that customized investment options, or is that kind of wishful thinking?
I'm sorry, I can't help but smile and excuse me to the audience. What Mike's referring to is there has been, and I've heard of this myself, where people are telling clients, they're moving, let's say, a private business or an asset with a low basis into a policy. No, that's not what should be done, and that's something that's really pushing the envelope, in our opinion. We don't agree with that planning, because this is a life insurance policy. You're using it for specific planning purpose. The code gives us the ability to do this within the rules, within the guideline. And private assets that someone is controlling should not be going into a policy. That's my firm's position on that.
And I'm sure you're going to talk about sorry, Frank.
No, go ahead.
I'm sure you're going to talk about this, but it seems like a lot of people these days are investing in crypto, in alternative assets, structured notes. Mm-hmm. What's the stance on that kind of asset inside of these?
What I've seen in the marketplace, depending upon the insurance company, if they'll accept crypto, more and more coming around to it. When I say accept crypto being an investment that a manager is going into, because what we're talking about here is cash goes into a policy. That cash value is allocated to an investment manager, and the investment manager then invests the dollars. Crypto, some carriers are being more limited on what they're going to accept there. As for things with structured notes, I haven't seen any of that in the planning that we've entered into.
Yeah, thank you.
Sure. Next slide, please. So in general, I mean, we're talking about, and I like to more, simplify this. It's a version of a variable universal life insurance policy that high net worth or wealthy individuals are using. What's their view on private placement life insurance? I mean, overall, PPLI is about enhancing investments by adding a tax efficiency with a required insurance element. And what that does, it provides planning certainty. So this is more where you have clients coming to us, and it's not, I mean, private placement life insurance, it's a life insurance contract, hands down. But it's not where the client comes and says, listen, I've done very well in my life. I've done my planning with my attorneys, accountants, and all the other advisors, and I need 10, 25, $50 million of death benefit. Go get me a private placement contract. That might not be the best use. There might be a retail policy that might fit better there because they're looking for the death benefit, low cost death benefit. For private placement, it's I've already moved 10, 25, $50 million into a multi-generational trust for the benefit of my heirs. I want to make that tax efficient, and because we're going to look to having alternative investments that are producing a lot of taxation, we want to have that run inside of a policy. So their view on this is really it's tax minimization from a investment standpoint. So we talk about, and I keep mentioning taxes. I mean, let's go just through an example of how taxes evaporate returns. I mean, there are a lot of political uncertainties in the world today. I mean, this is requiring, when we talk to money managers, a lot more active investment management, which, because a lot more portfolio turnover, they are generating more taxation. I mean, so the focus right now is on after-tax returns. It's not what you make, it's what you keep, and that's at the bottom of my slide, but I'd like to just jump right into that. I mean, because let's take a look as an example of a portfolio at 7%. And it's a hypothetical situation. To the left, we have a taxable portfolio. Let's assume it's earning 7%. And with this client, the average drag that they're going to realize from taxes is 3%. So it makes it very straightforward that we've got a 4% rate of return. Because of that tax drag, they're getting pulled down. If we took that same hypothetical portfolio and it was inside the private placement life insurance contract, again, earning that hypothetical 7% return, we're not going to have taxes because inside of the policy, you have no taxes on the investment earnings. But we are going to have policy fees. There are some charges. These are insurance companies. They have to administer policies. They have to, be in compliance. So they're going to have some charges. So we have an average drag from policy charges of 50 basis points in this example. Just look what happens. I mean, just there, that same 7% portfolio, I'm getting a 250 basis point bump in my earnings just by having it inside the policy. So as I just mentioned a little bit earlier, Mike, it's not what you make, it's what you keep. And just having it in this type of a structure can enhance what you're keeping. I don't know if you have any comment.
No, you hit the nail on the head there.
Thank you. So who is private placement life insurance for? I mean, this is more for ultra high net worth individuals, families, sophisticated investors. We talk to a lot of family offices. I mean, the owner, as I mentioned previously, you must be an accredited investor and a qualified purchaser to even enter into this policy. That's a U.S. definition. For all intents and purposes, everything we're talking about here is U.S. planning. So you have to be an AI and a QP to even get into this type of policy. The type of clients going into this are typically invested in inefficient investments that generate substantial ordinary income, alternatives. We'll throw it out as that. What they're looking for is cash accumulation, wealth transfer, and charitable giving, sometimes as part of the planning. They desire asset protection. Typical net worth is 20 million plus. I would say to you that it's higher than that, the average client going into this. So, I mean, the big thing to point out here is, look, as I mentioned, and I'm going to just keep saying this for making it simple, it's a version of a life insurance contract. It's a U.S.-based insurance policy with alternative investments. The right clients need to be looking to get into this. They have to have the right amount of assets. But this is a tool. This is a tool that we use as part of a much bigger plan for clients. Clients are going to have, and I don't want to jump ahead, but I mean, multi-generational trust structures, different business entities that are part of those trusts. I mean, it's really, this is a policy, is something that fits inside of a larger plan for a client to achieve a certain goal for them.
And everybody wondering out there, Frank's going to talk about what an AI and an AP is.
Well, we're just going to that right now, so thank you.
There it is.
So, I mean, what is an accredited investor and a qualified purchaser? And the definitions are as follows. I mean, an accredited investor fits within one of the following categories. I mean, and these are the SEC definitions: a natural person with a net worth of at least $1 million, natural person with income exceeding $200,000. If it's a trust with assets in excess of $5 million, not formed for the specific purpose of acquiring the securities offered. Again, this is an SEC definition, so in this case, it would be the policy. And it could be a charitable organization or corporation or a partnership with assets exceeding $5 million. That's just the accredited investor side of this. The qualified purchaser definition is even larger. I mean, if to be a QP, qualified purchaser, natural person who owns at least $5 million in qualified investments, family-owned company or a trust that has at least $5 million in qualified investments. If it's a trust, it has to be a trust that was not, again, put together just for the purchase of this of this policy. The grantor and trustees have to be qualified purchasers, and depending upon how the trust is structured, we could have a look back through to the person that's settling the trust. If it's a corporation or a partnership, or it's as an example, non-grantor trust, having 25 million or more in qualified investments. So you have a higher bar to get into one of these. And don't forget, this is an investment-linked policy. Like a regular variable universal life policy, there's investment risk. And I have this come up all the time with people when we're talking. What if it doesn't perform? Well, I mean, that's a risk that someone's going into in a variable policy, whether it's a retail variable contract, if the underlying mutual fund-like option doesn't perform, to the fund that's inside of a private placement contract. So it really has to be the right person that we're going to be, or family that we're implementing this for, that they understand that they're going into a vehicle that has some risk associated with it. But getting back to just accredited investor qualified purchaser definition, these are the rules of the road on that. And it does set the bar higher for someone to get into this. And clients that don't meet these definitions don't belong in this type of a product, from my opinion. So this comes up all the time, and it goes back to what you mentioned before, Mike, about you hear things of people, advertising, placing a private business or something in a policy. How can the funds be invested? Well, there's really two ways that funds can be invested in a private placement contract. As I mentioned, clients will contribute cash into a policy. From there, they can be invested in either an insurance dedicated fund, an IDF, or a separately managed account. And I'll drill down on that a bit. But an insurance dedicated fund, an IDF, it's a private fund, and it's only available to insurance companies. So this is typically going to be, use an example of a hedge fund. They might have a fund that's available to the public. They want to have something as an offering from an insurance standpoint. So they'll create an insurance dedicated fund that only insurance companies can subscribe to. Can't be a mirror of the same publicly traded fund, so they'll have some differences. They do get what's called look through for diversification purposes, and I'm going to drill down on diversification a little later. We're just giving you the definitions. And an IDF is most appropriate for a single investment. We don't see a lot of these, but it has to do with that diversification rule, which I am going to touch on. The other side of how can funds be invested is a separately managed account. So this is more where you'll have a client has a large RIA that will open up a brokerage account as part of the insurance company's separate account for the benefit of the policy. And that's going to be run in, let's say, a managed account format. So in a separately managed account, it's more of a direct investment into a broad array of choices. That SMA can also still go back and invest in an IDF if that's what the manager chose to do. but it's mostly, I would describe it as what I've seen is running large portfolios like managed portfolios. Now, a big thing here is they must be diversified. I've mentioned diversified previously. I'm going to drill down on that. It's really important. You have to have diversified investments. A lot of families and family offices, they like the SMA. It's what we have seen because they have the ability to have the investment manager recreate a taxable portfolio per se, but they'll be running that on a discretionary basis inside the policy. Big thing here, and I mentioned I'm going to touch on diversification, but the next on the last bullet is the investor control doctrine. We're going to go into these. These are two of the biggest things that clients have to be aware of. So with an SMA, there's more of a heightened awareness on the investor control doctrine, which we're going to touch. So let's go through these. I mean, the investment rules. And aside from the insurance rules, because you're really bringing together, we're talking about life insurance. So, the rules of life insurance, and then we have these investment rules as well as part of the putting this together. Really two main things you have to look for and abide by. It's the investor control doctrine and the diversification requirements. So a big thing here is the assets must be managed on a discretionary mandate. That's paramount. You can't have the client directly or indirectly influencing the investment decisions of the investment manager. And Mike, I'm just using this as an example. You're my investment manager. I'm not an investment guy, but my example would be I can't influence you directly or indirectly on what to buy, what to sell, what to invest in. I can't tell you, even on the side, let's sell Xerox and buy HP. That would be a violation of the investor control doctrine. So, the policyholder the owner, and they can say, listen, I want you to go into this type of a risk. This is the type of allocation I'd like to see you as the manager go into, the asset classes. You might be, as the owner, you can say, I want you to go into an IDF or even an SMA. But I cannot direct you on what to do. That's really important. A violation of the investor control doctrine is gonna deem the owner of the policy to be the owner of the investments, and you're gonna wind up losing your tax benefits that were afforded to you. Because this is really, insurance company issues your policy. That investment portfolio is being run on for the benefit of your policy. You might own it, but you cannot own the underlying investments. If you're deemed to own the underlying investments, you're going to lose your tax benefits. And there was a famous case from 2015. It was Weber versus Commissioner, where, and this is it's out there in the public. You can look this up. The gentleman was violating the investor control doctrine, and he lost all the tax benefits that were afforded to the policy. So there's some dire consequences there. That's when I said to you about a client you hear these things of people contributing private business interests. You can't control the underlying investment. And I just think that's an abuse. That again is our view. The other thing, aside from the investor control doctrine, the assets must be diversified. And this is more for the SMA, but I mean, we can drill down further with the IDF, but you have to have at least 5 investments. So no single investment can be more than 55% of the portfolio. No 2 can be more than 70%. No 3 can be more than 80%, and no 4 can be more than 90%. It's not a hard bar to meet. It's very important because there are penalties as well for the diversification issues if you don't meet that. But when you have an investment manager investing in managed portfolios that hold multiple holdings, it's easier to work within the diversification rules. So those are the 2 biggest rules that you have to adhere to in having assets run inside of a policy.
So Frank, could I tell my investment manager, you can be aggressive, I just can't tell him what particular stocks to be aggressive with?
Correct. I mean, you can tell him you'd like him to have a more aggressive investment strategy, might be able to discuss the potential strategy, but not the underlying investments that he or she is purchasing or selling. It's a hands-off approach. I mean, and it's really funny because, I see this all the time. We've been doing this for so long, where you've got this great strategy. This could be a retail variable policy. An investor control doctrine applies to regular variable policies. And you can I've seen this literature, in some of this general perspectives. I mean, it's you have this great strategy, the tax benefits afforded to life insurance, and yet you have people coming around saying, yeah, gee, can I stick my private company in there? I want to avoid the taxation on the sale. No, it's improper planning in our view. We just take a more conservative approach.
Excellent.
So in stepping back, I mean, with private placement, as I had said to you, there's just so much out there in the news. I mean, what are the types of policies that are available? It's a life insurance contract, but how can these be structured? So as I mentioned, I just want to touch on this, but we're really talking about U.S. domestic planning. I'm going to mention some of the offshore opportunities as well. For U.S. domestic planning, I mean, you have to meet the qualifications of a U.S.-based life insurance contract, which is going to be 7702 of the IRS code. Then you have 7702A. Is the contract going to be a non-modified endowment or a modified endowment? You can issue a private placement annuity. When we go into the international marketplace, and this is a policy being issued by an offshore insurance company, it could be in a jurisdiction such as Bermuda. I'll use that as an example. If it's a U.S. person purchasing that policy, it still has to be compliant for U.S. purposes. A lot of people don't realize that. You'll hear these, planners out there talking about putting a policy. Oh, we'll just stick it offshore. No, you have to be compliant for U.S. purposes. That's key. And again, you have to fall under 7702. You can have a 7702A MAC or non-MAC, but we can also expand into 7702. There's a 7702G compliant policy, a G frozen cash value. We can do an annuity. There's some other structures, but it's just touching on these for you. If it's a non-U.S. individual completely with no ties to the U.S., they have to still be compliant back to their home country as to when they're structuring a policy, even purchasing it offshore. We can also do custom designs, and I've seen this where you have some high net worth individuals as an example, they have multiple citizenships, such as a dual U.S. and U.K. citizenship. Well, you have different insurance rules, and there can be policies that can be designed to comply in both jurisdictions. This is really, very advanced planning, but I wanted to let the audience know that these are out there. For all intents and purposes, you're dealing with a U.S. person. 99% of these are just going to most likely fit being done within the U.S., one of the states here in the United States, under a domestic policy. So what are the planning opportunities that we can do with PPLI? As I said, it's life insurance contract. It's afforded the benefits of life insurance. A lot of times we see clients using this as a tax blocker on investment earnings that are held in a grantor trust or a non-grantor trust. They can use it to create greater value in multi-generational planning. Because it's insurance, I'm taking advantage of that tax compounding of tax deferral inside the policy. Again, I mentioned this before, you can have potential tax-free access to the income in the policy if it were needed. It depends on the policy design. Is it a MEC? Is it a non-MEC? You can only take those tax-free withdrawals from a non-modified endowment contract. This has come up previously. I had somebody say, how many times do you see clients taking an income stream from a policy? Rarely, ever. I mean, I think along the years, we've had clients borrow monies out and then it gets put right back in. This is usually, it's not the scenario where the investment manager, my view, is a client is going to be going into this and then they want to use this as a supplemental retirement income. It's just not what planning for PPLI is. But clients like to know that if I want to get my hands on the assets, can I do it? And can we structure it in a tax preferred way? And tax-free loans and withdrawals are part of the insurance code here in the U.S. And finally, for wealth accumulation, which I think speaks for itself, is again, we're putting assets into a U.S. compliant insurance policy, and that's going to compound and grow over time if you have positive investment performance. So let's walk through a couple of case studies. We will have some time for some questions. I don't know if you're getting them, but I'd love to go through some questions for some people as well. So these are actual case studies, things that we've done. Obviously, we don't have the client name here, but I mean, this is just a 59-year-old male. He's a California resident. So this gentleman, had a very high tax rate that he was exposed to. They had already done some multi-generational planning. I mean, he was looking to reposition 25 million of investable assets to get it in a tax efficient structure. This was already moved into a multi-generational trust. There was a lot more money than this that was done, and that was outside of the planning where we came in, and where we came in after they were working with the trust and estate attorneys. But they wanted to take $25 million and make it efficient for tax purposes. The goal was to minimize the taxes on the investments, achieve the tax-free transfer to the heirs, and protect assets from potential creditors. So I'm going to show you two policy designs. Again, US-based planning. This policy was in South Dakota, where we get a very low state premium tax, and you have a company like ILITs would be the trustee on this type of a transaction. But in this case, I'm going to show you the US non-MEC, which meaning that we're putting the policy deposits in from typically 2 to 5 years. We're going to get the cash values are going to grow tax deferred. We can access them through tax-free withdrawals and loans. The cost of insurance charges are paid from the policy as with a standard contract. And what we also do is we go into this and we reduce the death benefit at the earliest year allowable by the IRS to focus on cash accumulation further. We're going to call that the MEC testing. The other policy we design is just going to be a single premium MEC. And again, we also reduce that death benefit when allowable to focus on further compounding of the investment in policy. So this first one is just going to assume a 6% rate of return after investment fees before policy charges. This is the MEC, that we did first. So it's $25 million single contribution. And all this is showing, if you can go to the next slide, really on the left, we've got a hypothetical taxable portfolio. The tax rate here, and this is what the tax advisors asked us to use. This was all alternatives that they were investing in, so it's a very high tax rate. We're assuming 51.8%. As I said, the gentleman was California. So he puts in 25 million on the left. You're going to have $1.5 million of earnings. The blended taxes were about 747,000. That will leave us in the taxable account $25.7 million of cash. Going into, in contrast, over to the other side into private placement, depositing the 25 million into the private placement would immediately give him over $57 million of death benefit. Now the client could turn and say, I really, that wasn't my focus, the death benefit, but they have that's an added benefit that they're getting. But take a look at the cash value. Just on the same 6% after investment fees and after the policy charges, his cash value is $26 million, a little over 26 million. So he's cash flow positive on the investment over what they would have in the taxable account. There were policy fees and charges. It's about 446,000. Initially, you're going to have some structuring fees. You're going to have some DAC tax, state premium taxes. Those are in the early years. So as you'll see going forward in that column, it drops to a lower number. But the point here is I'm paying less in policy fees and charges than I would in my taxable portfolio. And I've got more cash growing and compounding for me. So jump ahead 5 years, the taxable investment would have hypothetically grown to almost 29 million, compared to in my policy, I've got $32 million of cash. Again, still having the almost over 57 million of death benefit. Just going out to 30 years, because that's mortality in this example for this gentleman. The taxable investment would have been 59 million compared to almost 119 million in cash value and about $125 million of death benefit. That's the power of private placement. So done correctly in the right, I would say, a state exempt structure, such as a trust, an irrevocable trust, a multi-generational trust. Structuring the policy in that type of a plan with these type of returns will produce a positive result. And then we'll just go to the MEC design because I want to leave time for questions. This is what we're doing here. We're going to put in $5 million a year for 5 years, same 6% return. If you just go to the next slide. So as you'll see on the left, we've got the annual deposit of $5 million per year. The reason we were doing this is so the policy would be a non-modified endowment contract. This is where during lifetime, the policy owner can take a loan and after a certain period, even a withdrawal of its basis on the policy and not incur taxation. So here we've got in the taxable account, just year one, I mean, we'd have $5 million going in, $300,000 of earnings. The blended tax rate was about $149,000, leaves me with $5.1 million in the taxable account. Go over to the policy, I'm actually still a little higher if you look at it. So same 6% return, cash value is projected at $5.1 million, and I've still got that death benefit associated with it. So that's really the focus here, is that I've got my policy charges are lower than my taxes I'm being incurred. I have this come up all the time with investment managers where somebody says, well, gee, that's great. You know, if my client just went and bought XYZ stock and held it for 35 years, well, then they shouldn't go into this. This is not something that's utilized for every client. In this situation, we had more of an actively managed portfolio. So jumping ahead 5 years, we've made the full $25 million in deposit. We've got the hypothetical taxable account at $27.3 million compared to $28.7 in cash value in the policy. And again, I'm still carrying that $57 million death benefit. Going ahead 30 years, $55.7 million in the taxable account, $105 million in the cash value in the policy, and we still have $111 million death benefit. So this is just stepping back and saying, if I had those same investment results, and I had the taxes on the left compared to the policy charges to the right, this would be the effect that we could be looking at. That's the value for clients. So really, I mean, just benefits of private placement. It's preserving assets through planning for wealth transfer. It can be a tax favored asset. You know, it can be used, and this is more for when we're doing the international side, alleviating currency concerns. Some clients want to get out of their home jurisdiction and have a policy issued in US dollars, and we can ensure privacy and confidentiality. Mike, do you have any questions or anything I can go through for anyone?
Yeah, it looks like a couple of questions popped up, Frank.
Oh, great.
Is the use case for PPLI to pay for estate taxes?
It can. I mean, it's still a life insurance contract. I mean, typically it's specific to the individual client planning situation. And I don't want to use that as some kind of like disclaimer, but it depends on what they're trying to do. And I mentioned it earlier. If you have a client that has, let's take an example. I've got a client that's real estate rich and don't have a lot of cash. They're not going to have the money to fund into a policy such as this. So they might look to a retail-based policy, maybe with one of your financing structures, you know, that's not private placement, because they need that for leverage. But if I have a situation where I have clients have significant liquidity, they still are looking at estate taxes. 99.9% of these that we do are going to be in some form of a multi-generational trust. So we'll incorporate the estate tax side planning into this as well. So it's a lot more involved. It's not just, you know, can it be used for that? Sure. Is it only focused on that? No. I hope that answers the question.
I think it does. And I think that kind of goes along with this due to the increase in the one big beautiful bill of the estate tax exemptions at 15 and 30. You know, if the client's not above that $30 million threshold or $15 million single life, really it's PPLI is probably not a solution for them. I think you kind of touched on that. A retail product.
I think even outside of, forget the $15 million exemption, aside that they don't have potentially an estate tax issue, no, they probably don't belong in it from a net worth standpoint. I mean, I choose to focus on clients probably 30 million and above, and it's going to be more of a liquid portfolio. And, you know, look, let's talk openly here. You've got a lot of people out there marketing this type of a policy structure to clients that don't belong in it. A retail policy, there's nothing wrong with a retail contract. I mean, I think this really depends on, it's specific to the individual client situation, what their planning is. It's, if does a client, I mean, they could be sophisticated, but at a lower net worth, if they understand alternatives and alternative investments and they make that accredited investor qualified purchaser definition, sure, they may want to go into this, but maybe they don't belong in it.
This one says, if the fund is an RIA account, do they need to sell or liquidate the existing investment first and then have to reallocate the investment fund?
An IRA?
An RIA account. So it sounds to me like.
Oh, an RIA. I thought you said it differently. I apologize. So you're saying if it's an existing managed account with an RIA?
Yes.
Yes. Yes. So policies have to be paid in cash. If an insurance company were to accept an in-kind contribution, and that's some of the games that are going on when we discussed previously about people like looking at putting a business interest in there, they'll make an in-kind contribution. So if an insurance company accepted an in-kind contribution of a portfolio, as you just mentioned, you have a recognition event because you're changing the ownership, as an example, from if I was the individual that owned the investments and I'm the owner of the policy, I'm transferring those to an insurance company. So any gain recognition would be triggered. And you also have to find a company that would take the in-kind contribution. Everybody we're working with is taking cash. So yes, they would have to liquidate the portfolio, and then it's up to the investment manager to redesign the portfolio within the policy.
Thanks, Frank. And I know somebody was asking about how do in-force illustrations work on a private placement life insurance policy?
Well, I mean, in-force illustrations work the same to any experience that I've had over the years. It works the same as a retail policy in-force illustration. I mean, the issuing insurance company will produce an illustration based on the parameters that the policy owner or a company like ILITCO that's administering the policy requests. And they're going to put out an illustration based on your investment return, current cost of insurance. It works the same as a traditional policy.
Thank you for that. And I don't see any other questions, Frank. I had one pop into my head, but then it left. And so train of thought must have been a short train.
Sorry, I couldn't help but laugh when you said that. I mean, I hope that the audience has enjoyed this today. I mean, my message would be, the one thing is, myself and my firm have had the privilege of dealing with some very wealthy people and families over the years, and whether it's traditional retail policies or private placement. I mean, private placement itself is just a tool that goes into a much larger plan. And I think that people just have to view it that way. It's not it's not a cure for everything. You don't have somebody, I mean, there are a lot of people marketing, move a private business into a policy. That you're just pushing the envelope there, in my opinion. We're taking advantage of the benefits of life insurance because it is life insurance. If you stay within the guidelines and the rules, you'll be successful from a compliance standpoint. And then it still does depend on the underlying investment performance.
Hey, Frank, the train pulled back into the station. So if you talked about the client in California that had done a lot of planning already and had 25 million in investable assets already inside of a multi-generational trust. If I'm, a hedge fund manager, a young crypto guy, and online influencer, and I've just suddenly gotten into all this money, how am I getting $25 million into my trust?
Well, I mean, I can only speak to the strategies that I've seen put in place from the trust and estate and tax attorneys and some advanced planning CPAs for clients, which I believe we have some teeny attorneys on this call today. I mean, so what we've seen is clients utilizing the gift exemption. Let's use the 15 million because it's an easy figure that we're going up to. There's also where clients will take, let's say, a business interest, put it into a partnership, and the attorneys can leverage that through discounting techniques. So they're gifting assets with some leverage. There's also things called sale gift transactions. to freeze an estate and move assets in prior to, let's say, a pop in value before they sell a company. Can be things such as grants. Those are the different type of strategies that we see. But it really is run from the attorney side of the planning, or let's say the CPA. They've got these assets in trust, so they're exempt, as an example, from estate taxes. It's a grantor trust. The grantor is still going to pick up that taxation on the investments. They may want to not have that happen. That's where something like a life insurance policy, including private placement, would come into play.
That's excellent. I don't see any other questions, but I really want to thank you, Frank, for taking the time today, and I want to thank LitGo and ITM for hosting these Trust Ed Universities. Keep an eye out for future presentations that will be very focused on education, which kind of goes back to the Trust Ed University. So,
and Mike, you'll see in this, I mean, we have a U.S. domestic private placement white paper. I mean, if anybody wants that, they can get in touch with yourself or LitGo. This is just a piece for attorneys, CPAs, advisors that talk about the basics of U.S. domestic private placement.
excellent. Thank you, Mr. Seneca. Appreciate your time today, and look forward to seeing you soon.
Thank you. It's been a pleasure being here. Nice seeing you, and thank you to LitGo for having me.